Welcome back, viewers, to FinMeUp Conversations. I'm Travys, the CEO of FinMeUp, and for this session, I'm joined by Wessel Grobler of Fairtree, who from our previous session has given an intro, but I think maybe just a refresher in half the time of where you are, what you do at Fairtree, etc., and then we'll get on to it.
Happy. Thanks for having me. Yeah, it's a pleasure to be able to share. I've been at Fairtree about 11 odd years now, kind of in a bespoke manner in terms of the portfolios that we construct in partnership with what we do with you guys. I think maybe in line with topic today, Fairtree has been kind of born out of the hedge fund industry. So I think might be a bit of relevance there.
Yeah.
Even started some of my years in the client services side. So
Okay.
I can tell you a few stories of people interested in hedge fund exposure.
Yeah, 100%. So I think just for more context again, like we said in the previous episode, that we've partnered with Fairtree for our asset management or portfolio management, execution on our investment strategy for our clients. And this specifically is an interesting topic, and I think where Fairtree is award winning, and maybe you could just speak to it. I mean, this is on hedge funds, talk to us a little bit about the background to your award-winning hedge funds, and just a bit of information around maybe a bit of a description on what hedge funds are for those that aren't necessarily that clued up, interested, but might find value.
100%. So I think hedge funds has got quite a rich history in South Africa, and I think most people, if I would think about the general person when they think about hedge funds, often is kind of that Wolf of Wall Street scenario.
Exactly.
So I want to say, like in the South African environment, not that. There's quite unique stuff that you can do in the US that you can't do in South Africa. And so maybe I think it'd be helpful to give a bit of history on where hedge funds started.
Absolutely.
Which I'll tie in with Fairtree in a way.
Cool.
So Fairtree kind of launched 2003, and in that environment, hedge funds were still managed as a limited partnership. So almost like a private equity type investment, you basically go into partnership with the hedge fund manager.
Okay.
And therefore you've got capital that's committed. It's often a little bit less liquid. It's mainly been driven by institutional investors that want a sense of exposure to an asset class that would be able to deliver something that is cash-like but not utilize cash, so outperformance thereof. And then there's some interesting things as it evolved. So if you were an early day investor, you received like a stack of papers to complete, like a legal document to go into this partnership. So it's very inaccessible.
Okay.
One of the things that we did early days to solve for that was that we put it on a banknote structure. So in essence, simplest form, the bank becomes the investor. You buy bank paper, the bank references the asset that the bank is holding, and you get the performance of the hedge fund, and you can combine different things. And so that kind of got entry in for the retail market into a hedge exposure. And then the industry evolved over time. So I can't remember the dates top of my head, but in essence, it moved from the general or the limited partnership to the CIS structure, which is the same as we would enjoy in the unit trust environment. So current form, it's still regulated under the same CIS structure, collective investment schemes. And then subsequent to that, there has been this kind of launch about 3 odd years ago where it's been the retail market. So retail hedge funds have got slightly different parameters in which they can operate. So often a qualified fund could potentially go up to like a 5 times gearing. So in its simplest form, maybe the best way to explain this is to say, property is a hot case in Cape Town. So we can use that as an example.
Atlantic Seaboard. Let's go specific.
So now I need to get my numbers right. Let's stick to $1 million because it's easy. Let's say you buy a flat for $1 million 10 years ago in the Atlantic Seaboard, which currently it doesn't price for, but in any case.
Yeah, I mean, it's probably worth about 50 million now, but
crazy numbers. But let's keep it simple, otherwise my math might fail me. So you often have to put down 10%. So then you say, okay, I've got 10% that I put down is 100K. I get worth $1 million in terms of asset exposure. Bought the flat, Atlantic Seaboard. The flat goes up 10%, 100K. Then you ask, simplifying, I know there's costs involved, but simplifying, how much did I make? You didn't make 10%, you made 100 because you went from 100 to 100.
Yeah.
So you got the return on the multiple exposure of
Yes.
your capital rather than just the amount that you put down.
Yes.
So hedge funds work in a similar vein. You can put down R1 and get R3 worth of exposure, potential up to 5, but often that's just a mandated thing. Seldomly does any hedge fund go up to 5 times gearing,
Yeah.
often roughly between 2.5 and 3 times. So the retail market is just kind of bring that gearing aspect a little bit down to 2.5 to 3 times, and then some of the qualified investors, that's your minimum investment value goes up to $1 million, and it should only be a portion of your assets. So it should be for high net worth individuals.
Yeah.
But this retail environment created this whole access point, and in its simplest form is to say what you gain access to is the same listed instruments that you would find in the cash equity environment. If you go to the JSE, just a derivative instrument thereof, a CFD as an example, and then in that you've got different tools to do. You can borrow it and put it short, sell it. You can go long, you can enhance some of the exposure, you can go into different asset classes in one portfolio. And so it just kind of, if you imagine a Swiss knife, you've got a simple one and you've got one that goes all these different tools. And the hedge fund is just kind of the same knife with different tools. And so you've got the ability to generate returns from different market environments. You're not just linked to markets going up or down. You can actually extract value when markets are going down. And so the award-winning thing, to go back to that, maybe early days when Andre Milan that started Fairtree launched his hedge fund, the kind of 2008 environment, markets were down 20 odd %, and then that hedge fund in the market neutral space was up 18 to 20% together with a long short. So that's a 40% outperformance. It's not to say that it is something that needs to do it all the time, but it speaks to the possibility to a different outcome. And I think that is mainly why it's introduced into clients' portfolios. It's got the possibility to give you something when the market has got nothing to give. So when you're exposed to the long only side, if it goes down, you go down. It's very tough to be able to express something differently there. Or even if you've got a view on a security or stock that you really don't like, you can actually express it by selling it short. So those are kind of the tools that you have there. And then you can go into like a whole range of different outcomes in terms of where they all fit. Tough to compare them. It's not always like for like. But it's a very interesting environment. It's something that Fairtree has been born out of. Currently, our long-only assets outweigh by far the hedge assets because it's just the nature of the market. There's just more to allocate to long-only.
And I mean, in terms of hedge funds, I mean, I know we use them obviously, like I said, in our portfolios as a hedging mechanism, obviously. You know, what are some of the, like, because you say Wolf of Wall Street, you know, there must be, well, there is surely a stigma around hedge funds, and I know they're classified as expensive, I think, comparatively to your long only or your sort of standard CISs. Can you demystify a bit of that for us? I mean, obviously they're expensive because you're generally performing when nothing else is performing ultimately, but maybe just give our viewers a bit of context as to maybe solve for one or two of the views on a hedge fund.
So I think it's often one of those things where you kind of pay for what you get, and for the hedge fund to have the ability that it has to be able to exploit these different market opportunities with these different instruments, you have to often go to banks, as an example, a prime broker, and they have to build a basket or create an instrument, and that's structuring costs and all of those things. So therefore, there's an excess cost involved, and then often the other conversation equates to the performance fees. And so that's more to try and align the investor with the manager. So to say when the fund performs, you actually, the manager can participate in that. But when the fund is down, there's a high watermark. So the fund has to win itself firstly, then only start paying fees. And therefore it protects the investor, where often other benchmarks then give you an example. If the market is down 11% and the fund is down, let's say the JSE Cap Swix as an example would be a benchmark, then that's down 11%, but the fund manager managed to do 5%. That's a 6% outperformance, and they get paid on it, but they still lost money. Where in this instance, as soon as it drops down its own level or last kind of best performance number, you can't pay any performance fees. And so it tries to align kind of what you do with the performance numbers, that it actually is to the benefit of the client. And then the other side of it, I think, is just kind of that complete risk environment. I think our South African environment is well regulated, so it's very different. So you can do weird and wonderful stuff in the US. We can put your shirt on the hedge fund if we wanted to, but
no, I like this shirt.
so you can price that and put it in the hedge fund, and then it becomes something. Or there's just too many things. So even maybe a good example of that would be, a lot of people are familiar with cryptos and Bitcoin.
Yes.
Even in today's environment, you can't gain access through a hedge fund into that. So that just speaks to the regulation. It doesn't say that I don't want to express a view to say it's good or bad or whatever.
Sure.
Genuinely just to say there's some form of protection. So gives you more tools. And hopefully over time, especially how we feel and view the ability of hedge funds is to not just protect, but actually enhance performance. Yes. We want to make sure that it adds value, alpha, because why would you pay a premium for something that just gives you cash-like performance? So we don't enjoy that.
And would it be fair to say it's best placed as a diversification tool, right? 100%. Like not as, you're not going to put all your eggs into the hedge fund basket, right? Yes. You're going to use it as I suppose like we've done, with limited exposure, increased exposure depending on the risk appetite of the target of the portfolio.
Yep.
And then, do you have any, like you said on the client side, you want to share a story or two? Give us something to do with, what you've had to, maybe give us a story of how you've had to work so hard to convince someone to put money into one of your hedge funds, client side. I mean, has been a lot of negotiation, one or two very difficult kind of brokers or...
So the best story there, maybe I'll tell you one of the stories. So in my very early days at Fairtree, I actually still answer the phone. So to give you an idea of where Fairtree started, there was no like client service, and a lot of these things didn't exist like many other companies. And then one of the things that I did was actually to help on that box. And so one of the stories that came in is that we had a client that phoned in and they want to invest into a fund.
Yeah. And
so one of the PMs is called Cor Boysen. And then the client said, no, they want to go into that, in Afrikaans, lang en kort fonds van Cor.
Okay.
And so they wanted to go into the long and the short fund of Cor. And the irony is that Cor didn't manage a long short fund. It kind of doesn't explain anything that they were looking at.
Yeah.
So you had to try and figure out from there, like, what is the client asking? Where do they want to go? And so it is.
What were they looking for then?
It was basically the Azagai, because it was the team that Cor was sitting in with together with Stephen Brown. Okay. Stephen was managing the Azagai. It was a long short fund, and so they just remember something about long, something about short. And the irony is, Cor is quite a tall guy, so it like
that's
kind of.
Were you talking about the person himself, or
you're trying to figure out like, what are you saying? And then Cor is actually sitting on the long only fund, so you're like, do you mean you want to go into this fund? Or so it's interesting things that you face at times. And then I think the best story of someone that was a bit like adverse to hedge fund investing early days is one of the guys that sit within the Fairtree business, that is joined as an advisor in a way. Mm-hmm. And in his own capacity.
So recently now? Or was this
he's been there 7 years. Okay. And so his journey has been in the 7 years that he was very like skeptical about hedge fund exposure. Yes. We had to really convince him, still in the note structure back then. And then he started seeing some of the performance number coming through. And now you try and convince him to use less hedge funds.
Yes. Okay.
So the journey is kind of equated all the way to the other side.
For me, it feels like that's kind of like I was saying, the general perception, I think because of all the movies we've watched, right? Yes. Like you said, like this is kind of, unless you educated yourself and you follow trends and you follow different vehicles and funds available to you as an investor, where, probably, I don't know, hazard a guess, it's like 80% probably don't. It just feels like that was kind of the stigma around it. It's like, well, this is not, so for someone that actively knows how to invest, right? This is too hands-on for me type of approach. But so
maybe on that, I think one of the things that we also try to do, especially in partnership with you guys, is say, even for clients that look to invest, the question is always how much of what do I put where? And we try and solve that. So we build portfolios with specific outcomes to say, at least trust guys that is kind of on the ground in
Yeah.
the midst of it to put the portfolio together to say, I need 30% of hedge fund exposure in this type of, or maybe up to 50%, or the correlation of this hedge with a long only portfolio actually gives you growth assets worth of 80% exposure, but at the volatility of less than a bond market.
Yeah.
And then that becomes interesting. I'm thinking of one of the clients we
Yes, yeah,
targeted
exactly.
together. It's like, it's an amazing outcomes-based tool,
Yeah.
especially for the advice business.
Yeah. No, that's exactly. I mean, this is full disclosure, just looking at any of our clients and viewers, is that obviously we play in the advice space, right? We're not asset managers or fund managers. We partner with, one of the best to do that for us, because that's where the expertise lie. We are good at automating process in this, and more on that probably later in the year. But yeah, that's exactly why we've got Wessel and the team on this. Yeah. All right. And just like for some of our youngsters out there, right? So like, let's say we've got, I mean, all the minimums are kind of $1,000 to $2,000 with any of the platforms that we kind of use. Give us a quick, what percentage of R1,000, for example, would you then put into, let's say it's a 30-year-old, they've recently just qualified as a professional. They've come to us as FinMeUp for advice. And, we're saying, okay, well, fine, we've got this solution, this mix portfolio that's going to work best for you type thing. What kind of advice, I suppose, or how would you view that R1,000 percentage-wise into someone that's saying, okay, well, it's a discretionary, they don't know what they're going to do with it, it's just they want to save, right? And let's say it's probably a 3 to 5 year horizon, maybe more, maybe less. How much of that would you then expose to one of your hedge funds?
So I actually, ironically, had a conversation with one of my family members on the way here.
Also, is he 30 years old, or he or she 30 years old?
Just over 30,
Okay.
basically 32-ish,
Okay.
32, 33 years old. Exactly the same question. There's a
Okay.
bit of a lump sum.
Yeah.
And we had a conversation. And I think one of the main things that most clients need to answer firstly is your time horizon.
Yeah.
I think that informs more than often your risk appetite, because risk is more time in the market.
Yes.
Than anything else. And I think there's multiple books and studies out on that. So not to go into detail on that, but I think if you're, let's say an investor that I don't know from any kind of bar soap, I would say one of the things that how we look at it is, if you look at it globally, you want to remove yourself firstly from your kind of home bias as a South African staying in South Africa. Where's the opportunity around the world? So I would say you take kind of 50% of your assets and you say, as a long only exposure, normal unit trust environment, go offshore. Try and invest that as much as offshore as possible. If you want, keep 20% of that. So let's say 10% of your total portfolio.
Yes.
As a local bias, if you feel there's an expression of the local assets that you would like to kind of take up. So that would be kind of the starting point. And then do a bit of diversification in terms of just the type of equity exposure that you pick up, so that you're not overly exposed into a quality type investor or value trap, as they would call it, or just growth, so that you diversify through factor exposure slightly. So different managers have got different skill sets in different environments, and environments and cycles do change, but it's often tough to call the exact moment.
Yeah.
If we look at it retrospectively, it's always easy to say, this is where it started. But no one went, we're not sure.
Hindsight is 20/20 vision,
Exactly.
or what is it? Yeah.
So I think that's kind of the starting point. Offshore as fast as possible. And then the 50% remainder is kind of hedge exposure.
Okay.
Give it to a growth hedge fund, multi-strat if possible. I think that's exactly what we do. We put 50% offshore, 50% in hedge exposure. Therefore, you've got growth assets, but uncorrelated. And so it gives you buying power in terms of not having to time anything specifically, gives you an entry point. So an example of that portfolio I'm kind of describing now, it's got multi kind of asset exposure. It's got multi a manager exposure in terms of just not just Fairtree as an example. In that portfolio, there's some outside exposure as well. And then we've got Fairtree on the hedge side. And the combination thereof in the worst 12 months would have been a -3. So it's fully growth, like 100% growth assets basically, with a negative drawdown of over 12 months of 3.
Yeah.
And you would expect something worse than that. If you think about the equity market as an example, JSE listed market, it can go down to like 20%, 18%, I think is the worst 12 months. So that's quite a big difference. So it gives you a bit of comfort, be able to sleep at night, but knowing that you've got growth assets to the max.
Yeah.
So I think that's kind of a great starting point to
Okay.
say most probably a little bit higher than you think. If you're uncomfortable, anything up to like 30% in hedge exposure will do you great.
Okay.
And then make sure you've got some growth assets, predominantly offshore on the other side.
Cool. Wessel, thank you very much.
Pleasure.
It's been great having you on. Any final remarks that you want to make? Are we good?
No, I think it's an interesting environment. I would say try as far as possible to cut through the noise. There's a lot of it out there. I think try and think objectively about stuff. Emotion investing is really tough. It's something
Yes.
hard to fight. And I would say maybe as a bit of an advocate to you guys is to say find an advisor that would help you to navigate this, because I think to have
Not an advisor, a FinMeUp
the
advisor. Yeah, geez, exactly.
There we go.
Come on. Won't invite you back.
Yes, go to FinMeUp.
Yeah.
Best advice in the business. Have someone that can kind of hold your hand through some of these things. It's generally needed at times. I think we overly involved emotionally in stuff.
Great. Thanks, Wessel.
Pleasure.
Cheers, everyone.